2014 recap. So yeah, we've been not talking for a long time. It's been some time. Been super busy. Last one I did was when I was in Indy. We were closing out on the duplex. So closed it out. Successful rehab. It wasn't a burr, but we got plenty decent equity. A lot of cash is in there sitting right now, but plan to refi in some time. So, to recap 2024, the goal was to buy one multifamily. As you know, we were focusing on indie market this year, building out our team, building out a portfolio over there. So last year we hit a home run and we got a really good single family. The renters are still there, the same one, they love it. Plan to increase the rent, so get the 10% cash on cash return. So first one, 2023 purchased as a proof of concept for the market, got 7% cash on cash return, and this is pure cash on cash return. So let's just understand that. Let's me explain. A lot of gurus out there are saying, hey, I'm getting 20% cash on cash return, 17% cash on cash return. I was like, what the hell? So finally digging through the numbers, what they do is they don't take out property management. We do property management, 10%, 8 to 10% is what you will usually get. Then you're gonna have capex. That is, what is capex? Capex will be a roof, HVAC, plumbing, serious stuff, windows. That will be capex because they are long-term investments and they take. Then there will be opex. Opex will be a lawn care, regular maintenance, break, plumbing issues, all that stuff. That will be capex, opex. So you need to allocate to a certain percentage or a scheduled number. So we at YBR Capital, as you know, we are serious investors, so we have our models out there, that we proprietary models that we build out. So each building we buy, we model out, what's the age of the asset, what's the age of the repair, and what's the capex. So roof will be 20 years. So the roof was repaired in 10 years ago, then you're gonna put in a new roof in 10 years, so you have to factor that in. And of course your holding period, so our holding period is 10 years. So every investment we go in there, we assume that we're going to hold it for 10 years. That's how much we're going to go for invest in capex. That's how much we're going to put in opex. And that's basically those things you have to put in reserves. So when people do their thing, they're like, hey, I got rent, I paid mortgage, PITI to the bank, whatever's left is my return. No, it doesn't work that way. That is voodoo math, and that will get you in trouble long term. If you are like doing a quick flip, yeah, that can work. But if you are trying to do something long term, because we're not sharing our like investment portfolio, the purpose of this conversation we're having is one, to help. This is me giving back because as you know, I've been doing this for a long time for other people. So I did it for JP Morgan, I did it for a private equity firm, and now my own firm. Okay, but what we're doing is I'm just sharing my knowledge so regular investors can understand how the big boys play, and that way you can mirror your investment strategy or kind of understand, does it make sense for you. So that that is what I was talking about for the cash on cash return. So you don't just do PITI, you take on the reserves. Once you take on the reserve, you realize, oops, 15 to 20% is the average. So you just lost 30% off the bat. So let's say your rent is 1,000 and you pay, let's say, 500 in PITI, then another 50% will 30% will be another $300. So you have $200, not $500. So your $200 will be your net cash flow back to you, and that is what you calculate as your return. So if you bought the property for, you did the 1% rule and you're like, why am I not making money? Is because you have to factor in the interest rate, because the interest rates, if it's higher, then you, even though you meet the 1% rule, you may not meet your 10% cash on cash return, because that's what we target. And I think that is a good benchmark to have, is if you can't get a deal all net out by for 10% cash on cash return, then long term you will not be making money. So I'm just trying to help the math over here. A lot of people are like, hey, I'm buying this, I'm buying that, but At the end of the day, you're paying for it one way or the other. So what we got on a portfolio was a 13% net return on our total portfolio. I'm not talking about our investor portfolio. I'm just talking about this exercise we're doing is to show, can you achieve financial freedom at that is $10,000 in 10 years by just buying rental, as a normal investor. So every year, so last year I bought one single family. 2023 we started, so we're going to continue till 2033, and hopefully in 2033 I'm having this conversation, I'm telling you, hey, I'm getting $10,000 in free cash flow, and boom, anybody can do it, and hopefully people can learn from this journey. So year one, 2023, one single family home purchased in Indy. Year two, 2024, purchased a duplex in Indy, and it's rented out. It seems to be better cash flowing. It's an older building, so that's one of my lessons I learned. But the thing was, older buildings have more deferred maintenance, and if you're buying if it's a duplex, you'll be buying from a landlord, so they're not the best out there. They were amateur landlords, and that's why we got a great deal, because they were like done. Like they were like, this is just too much money I'm spending. This is just too much work. They want professional management. They were out of state. I'm out of state too, but I have a team there, and they do a great job. So thank you, team. Without that team, I'm useless. So that's if you want to know about that deal, I went there and I shared all the numbers. I saw all the buildings over there, so you can take a look at that in the prior videos if you want more information on the duplex. But recap for 2024 is, yes, cash flow is going. I think free cash flow averaging around $1,000 a month now. So we reached 10% of our 10,000 goals. So in 2 years, we reached 10%, $1,000, and hopefully, as we continue, we'll make more increase our cash flow. Right now, the portfolio is supporting itself from an OPEX point of view, but not from a growth point of view, because that $1,000 is not enough to buy another property. So I'm still investing my own money into the deal, but I built up equity. I built up, how much was that? We calculated gain in equity, as in the price increase of the properties and all that stuff. I think it's 25,000, and overall equity that's sitting there is 150,000. So I've put in like 150,000 of my own money into this. So just to give you an order of magnitude, how much cash you need to bring from your pocket in order to continue this journey, because nobody talks about that. Oh, they're like, oh, we recycle capital, burr this, burr that, yeah, that's I'm just trying to show what a normal person who doesn't live in the city, doesn't have all the free time in the world, doesn't have an easy job, is it possible or not. So yeah, so I'm putting my own, but again, as I think after a point you will run out of your own money, and I'm going to model that. I'm going to model that, hey, after 2025 I'm going to run out of my money, so I have to go to creative financing. So that's what is the goal for 2025, is to buy another duplex. Why duplex? Because they're better at the cash flow. The downside for duplex is you buy from an investor, you only sell from it to an investor. It's very rare that you do that. And then that 5% thing, we're doing conventional loans, so we're doing 20% down. So again, that 5% thing to acquire, that's a strategy you can do. You will lose money, cash flow will be negative, but you will acquire the asset, and then hopefully the prices go up, and that strategy will not work. Why? Because let's talk about 2025 outlook, and then the strategy we will do. And what I'm thinking is, this is just me spitballing. I just got some time on Christmas to do this, so I was thinking about my strategies. I was like, let me just spitball here, and then I'll make more videos and the goals, and then you'll see me execute on that, and hopefully that will be a good playbook for you to understand how to execute, how to plan your real estate in 2025. You can borrow from my playbook, watch and learn. So here we go. So let's start with the big picture. Macro outlook, interest rates, that's one of the biggest things out there, is interest rates. Interest rates, the Fed is decreasing the interest rates. However, the treasury market, the 10-year is going up. So mortgage rates, as a lot of people kind of misinterpret, is not based on the Fed rate, it's based on the treasury rate. So treasury 10-year, if it's 4, you add like 250 basis points, so your mortgage rate is going to be 7.5. Investor, you add another 50 basis points, so average investor rate should be around 7.5 to 8%, this year. That's what YBR Capital is forecasting. There's And the reason for that is the Treasury, the Department of Treasury, they're issuing a lot of debt, and that debt is the driver for the yields. So the bond market is saying, hey, USA, you're spending too much money, you don't have enough revenue, your debt to leverage, debt to equity, debt to income ratio is too high, just like you and me will face. And they're like, you have to pay more interest. So that's what's going on. And that is why, with the current administration fucking up, the fiscal situation, and the new administration coming in, which wants to spend, the American way, that's gonna be uh, a headwind to the mortgage rates. So that's one of the big in macroeconomic factor. Second is the economy. So globally, the economy is slowing down. As global economy slows down, it will have a second derivative impact on the American economy. And the American economy is going through a rolling recession for the past 2 years. So what do you mean by rolling recession? It's like one sector goes down, the other sector kind of holds up, then the other sector goes down, the first sector kind of goes up. So the best example is technology. So in 2022 and 23, you saw layoffs. So technology was in recession. Now it's kind of emerging out of the recession, but now real estate is in recession. Manufacturing is still going up because of the inshoring demand. So places where there's a lot of manufacturing, jobs, they're kind of benefiting. So in 2025, manufacturing, uh, and trucking and all those core businesses will continue to grow. Real estate will go down, technology will be meh, finance will be meh. So that's the big picture for 2025. You may not get a recession, it'll be like 1%, 2% growth, but the unemployment rate will go up because now the niche areas, even though they were high value areas like technology, finance, they employ less people, whereas now the broader economy is going to slow down, and that involves more people. And if it involves more people, then the volume or the number of people that's going to be laid off is going to be higher. So construction, for example, is a good example, where a lot of folks might be getting laid off soon, as the slowdown happens, and the manufacturing will kind of pick up steam, but not enough to offset everything. So unemployment rate should be like 4.5 to 5% this year. It'll be trending higher. Crash bozo, so economy is ending, people are dying, whatever. That's not going to happen. So home prices will be flat to up 3%. That's our forecast. And then based on everything else, demand for housing is going to be flat to down versus 2024. Again, that's driven mostly by first-time home buyers exiting the market, investors mostly exiting the market, except hardcore folks like you and me, who know what we're doing. All those syndicators and all those, quit your job in 2 years by buying rentals. Yeah, they're gone. There's no way in hell they can survive this market, because this is a tough market. Transactions will be down. So on the realtor side, there'll be pain. So that's the outlook for the economy. Now, based on this scenario, what is the investment strategy? So we're not going to change market. The markets we work in is Florida, because of again demographic growth. Indy, stable cash flow market. But it's no longer the best market out there in Midwest. The best market right now in Midwest is Ohio. So Cincinnati, Ohio is a great market emerging, and now and areas around it. I think th- that will be the story in for Midwest cash flow investors is whoever was in Ohio and has the systems is gonna score big. We picked Indy, I think, based on our just our connection to that market, and now we build a team. It's apples to oranges comparison in a sense. You know Markets go up and down, nothing big, but yeah. Midwest, then Minneapolis is a emerging market. So if you look on the trending side, Indy won't be one of the top markets to invest in 2025. They are much better markets. So if you're a new investor, you should look into markets. And how we define markets is, hey, there has to be population growth, there has to be economic growth, there has to be wage growth, and the policies have to be right. So indeed the wage growth is going down or stagnating. Population growth after the pandemic is now kind of starting to slow down. Ohio, on the other hand, with the manufacturing, as I laid out the thesis, the manufacturing is going to drive this year's gains. So Ohio has a lot of manufacturing over there, and they are the ones who are going to benefit from that uptick this year, and that's the tailwind behind this. So whoever's investing in Ohio and has the connections and the market and the team, good luck, and I hope to see that. But we're gonna stick to Indy because that's our thesis. We stick to a market, we become an expert there. So the markets we invest in, as we said, Florida, Indy, and then Phoenix. Phoenix is an interesting market. It has a lot of good things going for it, but there's just too much investor activity gone there. The deals are not there. The juice is not worth the squeeze. So we are, still watching that market. We are not going to invest in that market this year. We're going to focus on Indy, and we're gonna, try to, get some deals over there. So how do you get deals? That's been the question for the last 4 years. And as you build relationships, you get some deals, but all the MLS deals will be average deals. So if you're looking for a 10% year on year cash on cash growth or a cash on cash return, it'll be very hard unless you get very lucky. You will get a buyer's market in most places. Actually, Phoenix is technically a buyer's market as per Cromford Index. They're the ones who are one of the leading real estate data providers over there, and they have solidly put Phoenix right now as a buyer's market. Buyer's market usually do not last long, so maybe you have an opportunity of 6 to 8 months in Phoenix when the buyer's market lasts, and the opportunity, the delta disappears. There's still a lot of investor money out there, and a lot of folks who have moved from different states to invest there. Pace Morby and his students are like living there, so there's a lot of amateur hour going on over there. So we'll see how that turns out. Indie, same thing. It's a slow market. I don't expect prices to go down. It'll be flat or stagnant. That's what it is. 2020 to 2022 was an outlier for Midwest. I think Midwest is going to go revert back to being a linear market. So there's three types of market. There's the growth market. So for example, Silicon Valley, Phoenix, Florida, they'll be like growth markets. Prices go up, and prices come down. And then there's the hybrid markets. Hybrid markets will be North Carolina, Tennessee, those will be hybrid markets, a combination of growth, appreciation, and rent. And then linear markets are, the Midwest markets where rents go up by 3-4%, prices go up by 1 to 2%. So that's a cash flow market. So I do not expect the rents to go up really high, and do not expect the prices to go up really high in Indy. But what we are looking for as part of this experiment is, can we take our paycheck and mirror it by substituting it with real estate. So let's buy another duplex, but this time we're gonna be 100% focused on getting a fantastic deal, because it is still there's gonna be buyer's market, there's gonna be stress. So the opportunity is there. Now it is on us to kind of hold our emotions together and not invest anymore. Like if it's your first deal, yeah, don't worry about 10% or whatever. Just make sure it's positive, at least 2% after paying for everything. So at least your paycheck is not continuing supporting and somebody subsidizing somebody's life over there. You don't want to do that. If you want to do that, get married or something, or adopt a kid or have a kid or whatever. But I don't think that makes sense to support a random renter unless that's your thing. uh, Anyways, we will keep this PC. Uh, moving forward, what we're gonna do is, that's our goal: buy a duplex, 10% cash on cash return minimum. Okay, if we have to do a value add, we will do a value add. Now, getting a deal out of the MLS, highly unlikely, but of course we're gonna do that. But what we're gonna do is we're gonna open a new channel, and the new channel is gonna be, we're gonna do marketing, aka we're gonna find motivated sellers or find motivated investors via uh, you know advertising. So we're gonna send them mailers, we're gonna send them emails, we're gonna do cold calling, and wholesaling. I tried last time, I didn't get a really good deal, so I'm not sure. So this is what I'm gonna do. It's a new strategy. Let's see how this goes. So we're gonna use one of those lead generators. We're gonna get the list. We're gonna send out the mailer campaign and see. So that's our strategy, and let's see how that goes for the year. So that's about it for this live stream. I see a couple of folks here, so thank you for watching me live. Appreciate that. This was off the cuff, so I don't know how YouTube found you, but I guess uh, glad you're here. Ask any questions. I'm doing this on my phone, so I can't answer your questions right online. But yeah, I'll just ping me or put it in the comments or whatever, and I'll get back to you on that. Um, yes, so thank you for watching, and it's been a very fun, interesting 2024. We achieved our goal of one rental at a time. Mike Zuber, love that guy. If you guys are gonna be in his Feb event, yeah, ping me. I'll be there. Love to meet everybody. And that's another goal, is now I'm gonna be more active on the networking side. I'm just doing my own thing, but now we're gonna. That's another goal, is to network. And then if I can find, so the goals are single family or a duplex, 10% cash on cash return, find a great deal, do marketing, seller financing. So these are the goals for 2025. Hopefully you will join me on my journey, and hopefully I can achieve it. And any questions, ping me. I'll make more details. That's one of my goals for 2025, is do at least one a week or one every 2 week of share my knowledge on the analysis of the market and other stuff. Love the feedback, because you guys, if you don't enjoy what you're watching, then it doesn't make any sense. So love to get some feedback on the topics to make, and any questions you want. Again, this is Sid, your buddy from YBR Capital, ex-investment banker, ex-NYU Business School. I have the knowledge, and I just want to make sure that I can prove the folks one way or the other, right or wrong, that in 10 years you can achieve $10,000 in monthly cash flow investing in rentals using your own money, no outside money, or maybe outside money. We'll see where the journey goes. But right now, first year done, second year done. We're gonna go in third year. We're gonna invest in one amazing deal, no outside money, using our own money by saving $50,000 to $80,000 a year. Tough task. So you have to sacrifice life. I did not go on any real vacation. I went on work vacation, as you saw on that. So yeah, very excited for next year. Thank you all for watching. I gotta go, but loved it. See you around. Okay, take care. Ciao, ciao. Bye.